Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name's Corey Kramer. Today, we're going to be analyzing Trade Desk, ticker TTD. This one came in by request down in the comments of one of my other videos. If you have a request, put it down in the comments. I'll get the ticker up on the chalkboard behind me, and eventually I'll make a video for you. I owe the person who asked for this one a tiny apology. Because you can see you probably can't see it, but it's the one by itself down there at the bottom, one of the erased columns. About the time I got to it on the list, I had been tracking it for a long time in the Cyclical Investors Club, and it was below the buy price, and I had been kind of waiting for the momentum, or at least some sign of a bottom off of this free fall before I made a decision whether to buy it or not in the Cyclical Investors Club. So I eventually did. So I was kind of delaying making a public video since the folks at the Cyclical Investors Club are the ones that actually pay me. I didn't want to give the public the idea before they got it, because it wasn't totally clear. It was kind of a judgment call whether I was going to buy it or not. And that process went on for a couple months. So we did end up buying it just off the bottom, and then it's up like 45 or 50% or something now. So it all happened really quickly. But I will go ahead and I'm going to do a time until payback analysis. This is a little bit different than the fast growth strategy that I use in the full service. So it's not quite as dynamic and precise, I would say, but it'll give people an idea of kind of what a good price to pay based on future earnings would be. As always, this is not individual investing advice, just how I analyze stocks. So let's look at the AI description of what they do. They're basically in the advertising business. They do programmatic advertising platform, right? And they're known as like kind of an independent platform, so that they're not selling ads on their own platform, but on other people's, unlike Google or something. So they plan, buy, optimize, measure digital ad campaigns. Looks like especially the connected TV ads, which you see more and more of. That's definitely a growth area. I see it on mine, on my Roku television. And if you just think about it, all the streaming services have pretty much launched some form of ad tier now. So you can kind of see how there could be some growth coming out of that, and how you might not want to align yourself with one of your competitors if you're Netflix, dealing with Google or something like that. I'm just picking those out of the air. Okay. So newer business, went public, it looks around 2017. Earnings growth upwards of 35% a year. So really great earnings growth. There's not much to dislike about the company. I would say there's two concerns. One is cyclicality. And that's part of the reason why let's go back to the previous sell-off. Now, when you traded a really high multiple like this, like 122 PE, it can compress. I mean, when it compresses down to 40 PE, you lose 60% if it happens quickly and earnings aren't rising. And they can't rise in 6 months that fast anyway. So you can get these opportunities sometimes when the market, when it's trading pretty richly valued, and then there's any kind of like a hiccup in the future or worry about the future. This would usually advertising is cyclical. So if there's a recession, so that means your earnings could go negative, right? So earnings growth anyway. So you see they're only expected to grow earnings 7% this year. Well, that's not very much for a stock trading at an 85 PE. And maybe the market thinks that was going to fall 10%. I'm just making that up. Well, going from 32% growth to 10% decline, that's how you get these gigantic sell-offs like this one. So we'll call it almost 70% from the top to the bottom. So I was watching this and tracking the decline. And it can be a little tricky here, especially on a growth strategy, to try to get a good price. And also, it could look like a good price at various points along this, but I've kind of gotten to the point where if a stock is in complete free fall like that, a growth stock whose multiple is compressing, I bet it didn't even get like super cheap on a multiple basis. Yeah, at the cheapest, it was like 27 PE still, right? So it's not like it's super just cheap. Even if they grew earnings, in the teens over the next decade, it just kind of justifies that valuation in my mind. So the market can quickly come to like reality when they start worrying about earnings growth decline. And that's pretty much what happened. Then we got we have tariffs, we have everything, all the stuff that goes into that. And then we get kind of a reversal on some of that, or a delay, or whatever you want to call it. And so now the market is getting more optimistic again. Probably mostly about avoiding a recession. Although I know like Shein and Temu do advertising. I don't know if they go through Trade Desk or not. So I don't know all the intricacies, but I do know recessions are going to be bad usually for advertising. And if you go in with a high multiple, you're going to get punished more. So I think that's the story there. So now we bounced off the bottom a little bit. I got a position for the folks, a small position, but at least we got something. Kind of made a judgment call because really momentum wasn't really positive yet. I just had a little snippet of a sign right down here somewhere, and that it was done, or it paused the free fall, and it could reverse again. If we have a recession, it could go back down again. So just because it's jumped off the bottom, and that's why this video still could be useful. Who knows what the summer's going to bring, right? So the way I'm going to do this for this video is, what I want to know is if analysts are correct about earnings to a year and a half out, basically. So it'll be basically, usually I'm looking at forward earnings anyway. So one extra year will go forward and assume that they can do 212. Actually, I might not even need to do that now that I'm looking at this. I might adjust it, and I might maybe I'll just do the 178 when I get into the spreadsheet, because I don't think I need to adjust it much. But either way, I'm going to assume if they can grow earnings 20% a year for 10 years, or however long it takes, how long would it take you to earn your money back from the earnings if you bought the whole business? So if you paid $100 for the business, how long would it take to earn $100 just from their earnings? And that 20% growth seems reasonable here. That's basically what's being projected after this slow year. And they were a little faster last year. So if you kind of average the 5 years together, you're getting in that 20% a year roughly range. So let's take a look at that. Okay. So I was looking at forward 1 year, but I think I'm just going to go ahead and use $1.78, and then I won't have to, because they're only expected 19% growth. Okay, so here's how this works. I'm going to assume I pay $100 for this business, and I'm going to pull forward the first year's earnings growth of 20%, and then assume that they can grow earnings on average 20% a year after that. And I want to know how long it will take for those earnings, collectible earnings, to equal $100, like whatever you pay for the business. But it's easy if you do $100. That's how I set up the spreadsheet. So the way you do that is the earnings yield, using just this year's forward earnings, is 2.25%. So if you paid $100 for the business, you would earn $2.25 on your $100, and you would get to keep that. Now I am going to assume that this grows 20%, because that's how I have my spreadsheet set up, and that first year, and then we'll go from there. So let's scroll down here and I can show everybody. So first year, $2.70 on $100. You keep that, and that 270 grows 20%. Not 102.70, just the 270. So the next year you have $3.24 that you can keep, and the next year $3.89, and then $4.67, and then it goes on. And I want to know how long it would take for that to accumulate to $100. So I would turn my $100 investment into 200. And it looks like it's at about 11 years here, or 12. It will take 11 and a half, 12. So that is, and then in my notes I have plus 1 year, but I took that year off because I went ahead and used next year's earnings. So this would be, sometimes this is like the high end of what I would pay for a growth business. And so let's put it this way. If you think that we are not going to have a recession in the next couple years, then this is the price it's at right now is probably a fair price to pay for this stock. However, if you think you could get a period of weakness sometime in the next 18 months, the time until payback, I prefer to be 10 years instead of 12. And I actually think this actually works out to, this was 9 years. I think what I wanted was 62. I'm going to try. So we need to get down to 10. Maybe not. I did this ahead of time, but then I changed the number slightly. So we'll just see what it works out to. Yeah, maybe it is 50. There's 10. Slightly more. There you go. $55 a share is what you'd look at to get. All right, I screwed that up. So $55 a share would be the point where it would pay you back in 10 years. That is probably the level I would aim at, because I do think just because we got a relief rally and boost from delayed modified tariffs doesn't mean we aren't going to avoid economic weakness or a recession. So what are we at now? $80. I don't know what it's doing today. So we want to wait, and then it bottomed at 45. So we know that at this bottom, you know, if it went down and made a double bottom at some point or something like that, that's going to be below that $55 level. I think that that's probably where I would aim to get a little bit more margin of safety. And, you know, it helps you get better returns also if you can get a lower price, right? So I kind of waited for it to hit that $45 level, and then when it kind of came off of it, I don't remember the exact price, but it probably actually was right around, you know, the $50-ish level when we bought in. So that would be my preference. But again, maybe a person's holding a lot of cash. Maybe they don't think there's going to be a recession. They feel very confident about that. If you're one of those folks, taking a small position here, I wouldn't take a full position, you know, but taking a small position here, getting a little piece of this business just in case it doesn't come back down. Now, traditionally, we've got some pretty good viable pullbacks, you know, at least one good one in 2022. Not as good as this one. We're kind of where we're in 2022 right now, I think, yeah, valuation wise. So you could definitely still do okay with it if things are all good. I'm not totally in the camp that they're all good, so I'm still trying to buy things when they're really cheap. All right. Sorry I had a delay on this one, you know, but the members come first. And I do have links down in the description. There's a free tier over on Patreon. I have weekly picks on Patreon for $25 a month as well. Those have been really crushing the S&P 500 since we started it. They fell less during the decline, and now they're kind of even gaining more on the way out. So that's going really well. Everybody's really happy with that. Check out those links down in the description. Give a like if you enjoyed the video, and I'll see everybody later.